Class number 2, Balance Sheet Structure 101. The balance sheet is a universal scorecard for all businesses. In this class, we'll introduce you to some concepts that will help you to discuss and think about how your credit union is doing.
There's a very common formula for accountants as they look at a balance sheet. Assets have to equal liabilities plus equity, and equity is commonly broken down into retained earnings and capital.
When you think liabilities, it's a simple term to understand. You owe somebody something. How do you pay off your liabilities and how do you settle? Use cash and other transfers of assets. Liabilities are simple. They're bills. Pay them.
An asset in its simplest form is something you own. It is a tangible or intangible economic resource.
The credit union has different types of assets, some earning, some non-earning. Generally speaking, loans are the highest earning asset the credit union holds on its balance sheet.
When evaluating line items on a balance sheet, it's a very good practice to compare the current balance to prior periods. That enables you to detect any trends, positive or negative, to be followed up with research.
When you think about a balance sheet, the assets are divided into categories. One of the most important categories to consider is the ones you earn from, your earning assets. Those would be loans and investments.
Some examples of non-earning assets would include fixed assets, prepaid expenses, and accrued income. Regular reserves, undivided earnings, and other reserves are all forms of capital in a credit union. As a liability is defined as something you owe, shares and deposits would be considered liabilities. They are not equity in a credit union. Things that comprise the right-hand side, or liabilities and equity side of the balance sheet, include accounts payable, member shares and deposits, and capital in the credit union.
Assets equal liabilities plus capital and retained earnings. A liability is something you owe. It's an obligation to pay for a transaction or event in the past. Settlement could require the transfer or use of cash or other assets. In its simplest form, an asset is something you own. Assets are economic resources or anything tangible or intangible that is capable of being owned or controlled to produce value. Typically, the largest and highest earning assets in a credit union are its loans. Balance sheet line items should always be compared to prior periods to understand the trends in specific line items. Loans and investments are considered earning assets. Fixed assets, accrued income, and prepaid expenses are examples of non-earning assets. Line items on the balance sheet that are considered to be capital of the credit union include regular reserves, undivided earnings, and other reserves. Shares and deposits are not considered equity. Equity, accounts payable, shares, and deposits make up the right-hand side of the financial statement. Time to take the test. Good luck.